it's a Colonel. Good evening, guests. A warm welcome and special acknowledgements to Honorable Joseph Farrell, our Premier and Minister of Finance, the Honorable Charles Kernan, Minister of Education, the Honorable Veronica Dorset Hector, Parliamentary Secretary, heads of departments, Financial Information Month partners, or former resident representative of the ECCB Agency Office, Mrs. Claudette Weeks. It is quite my pleasure to represent the 22 partners for Financial Information Month Festival 2023. It has been rebranded this year as Financial Information Month Festival. And I welcome you to this event on their behalf to this forum dubbed the Nuts and Bolts of Investment. This is our first in-person event as we concentrate on activities during this week. So on Montserrat, this is FIM week. All of our activities are geared at achieving one main objective: financial empowerment through education, the general theme for Financial Information Month. This year, our 22nd year, the regional focus is wealth creation for financial resilience, and we, the partners, say thank you to you, the public, for being the source of inspiration for the sub-themes, which we derived in relation to wealth creation for financial resilience. There are three sub-themes: investment, financial literacy, and financial legacies. While on the surface, this event is aligned with the first sub-theme, investment, it is intrinsically linked with the other two sub-themes, as I am sure you will discover by the end of this evening's two presentations: the nuts and bolts of investment. Reference to the idiom, nuts and bolts, according to the online Cambridge Dictionary, highlights that the reference is about the practical facts about something and not just theory. In effect, the essentials. So when we thought to bring to you the nuts and bolts of investment, that is exactly what we had in mind. How does it tie back to wealth creation for resilience? Well, if you have the practical knowledge, entangle that with the right tools and vehicles, which I am sure you will learn about this evening, and you are on your path to changing your trajectory and Montserrat's trajectory, or wherever you are based. Remember Governor Antoine's familiar expression: you cannot change your history nor your geography, but you can change your trajectory through wise investments, inter alia. I am adding that. So as we move along into this session, I ask God's divine intervention that He presides over the time we are investing here this evening, that in some form or fashion, we reap the rewards of this investment of time. I now invite to the podium Ms. Jasmine Taylor, our chair for this evening. Jasmine is currently the Deputy Director and Financial Controller of our FIM partner, the Social Security Fund. Jasmine's career with the fund spans over 20 years as the assistant accountant as well as the investment manager, and she is a qualified accountant. Jasmine is currently a member of the Board of Directors of the ECSE, that's the Eastern Caribbean Securities Exchange, where she also serves as chair of the Budget and Finance Committee. I can tell you that she was quite instrumental in this evening's materializing. Quite excited about it coming to fruition. Outside of the office, Jasmine enjoys spending time with family, especially her niece, nephew, and her 11-year-old daughter. Jasmine, welcome.
Good evening, everyone, and welcome once again to this investment forum under the theme, The Nuts and Bolts of Investment. Ms. Eswick, she did a fantastic job introducing the reasoning and the behind this afternoon's session, so I will not lament that point. This afternoon, we have two qualified and knowledgeable presenters. We have Mr. Chesley Antoine and Mr. Alan Sheppard. Mr. Sheppard will be joining us virtually, so we are going to ask you to indulge us once he is on the screen, and Mr. Antoine is here with us in person. Just a few housekeeping matters. Mr. Antoine will be our first speaker. Once he's done, we will go directly into Mr. Sheppard's presentation. And then after that, we're asking you to make a note of whatever questions or comments you might have for our presenters and ask them at the end of the presentations. Thank you. So before I invite Mr. Antoine to the podium, I would like to read a short bio of him so we can get a better idea of who he is. Mr. Antoine is an accomplished finance professional with over 18 years of diverse experience in the banking sector, as well as the social security, financing, and investments. Mr. Antoine, I'm sorry, I interchange between Antoine, and he has assured me he has no problem with that. Mr. Antoine currently holds the position of Assistant General Manager at the Bank of Montserrat, where he oversees banking operations and investments. Prior to his current role, Mr. Antoine worked at the Eastern Caribbean Central Bank as a bank examiner and relationship manager, with responsibilities for supervision, examination, and regulation of one of the largest banking financial institutions in the Eastern Caribbean Currency Union. Mr. Antoine's experience in the field of finance began at the St. Vincent and the Grenadines National Insurance Services, where he started as a teller and worked his way to teller supervisor and accounting and investment officer. Beyond his professional career, Chesley is an avid reader of Stoic philosophy and a gym and cricket enthusiast, a martial artist who enjoys the magic of sunsets and sunrises. He is also passionate about education and personal development and plans to one day retire as a university lecturer. Join with me to welcome Mr. Antoine to the podium. Sorry to interrupt. I was advised to let the general public know that we are online on the Spirit of Montserrat and also on the Philo Magic Media. Thank you.
Pleasant good afternoon. Okay. My presentation today would focus on giving you guys an overview of investing. Okay, so investing is a fundamental aspect of personal finance and wealth building. This presentation provides a comprehensive overview of investing and covers some key concepts such as the importance of investment goal setting, risk and return, risk tolerance, diversification, asset classes, and the pitfalls to avoid when investing. So we'll be talking today about what is investing, why do people invest, essential concept of investing, types of investments, and of course the pitfalls to avoid when investing. What is investing? Investing is a process of allocating financial resources with the expectation of generating profit or income over time. It involves purchasing assets, financial instruments, with the hope that they will appreciate in value or generate income in the future. By virtue of this, it plays a critical role in personal finance and is a cornerstone of building wealth. Why do people invest? People invest for a variety of reasons, and these reasons can differ from one individual to another. Some of the most common motivations for investing include, as you can see, we have 4 individuals who all have different investment goals. We have Dave. Maybe Dave is from Alveston, for example, and Dave is interested in wealth growth, retirement planning. And we have Sharon. Maybe Sharon is from Lookout. So Sharon is interested in entrepreneurship, hedging against inflation, seeing that she's probably a business lady. And she's also interested in building wealth for future generation. Now, Sharon is related to Jamal. Jamal is interested in speculation and passive income, right? Grace, on the other hand, who is interested in ethical and social impact of our investment decisions, and she's also interested in setting financial goals. So when we speak about wealth growth, this is the primary reasons why many people invest, which is to grow their wealth over time. By investing their money, they aim to generate returns that exceed the rate of inflation, ensuring that their money retains or increase its purchasing power. Now, if we speak about retirement planning or retirement investing, many persons invest to secure their financial future during retirement. All right, and if we move on to Sharon, who's an entrepreneur, investing in one's own business or entrepreneurial venture is a form of investing. People do this to start or expand a business, potentially reap the financial rewards from investing in an alternative business. Sharon is also interested in hedging against inflation. Like I say, Sharon is probably an entrepreneur, she probably does trading outside of Montserrat, and she's interested in hedging against inflation. Inflation erodes our purchasing power over time, and investing can help to protect against the impact of inflation by providing returns that would outpace or outperform the rate of inflation. She's also interested in wealth building for future generation. As I mentioned before, Sharon is the sister of Jamal, right? And Jamal is interested in speculation and passive income. Now, investing in speculation is a high-risk venture. So Sharon, the responsible person, she's interested in building wealth for future generations. So she's basically supporting, putting herself in a position that she could support Jamal's risky investing activities, right? So if we move on now, before we go to Jamal, we move to Grace. Grace, who's interested in ethical and the social impact of her investment decision. Social responsibility and ethical investing is gaining popularity in our globally. That is, investors may choose to put their money into companies or funds that align with their values and promote positive social or environmental outcomes. She's also interested in our financial goals. People invest to achieve specific financial goals, such as saving for retirement, buying a home, funding their education, funding their child's education, taking a dream vacation. Investing can help them build the resources needed to achieve these objectives. Now let's move on to Jamal, the youngest of the lot. Jamal is interested in speculative investing. While not recommended as a primary investing strategy, some investors engage in speculative investments, hoping to profit from short-term price fluctuations in assets such as cryptocurrencies or high-risk stocks. Jamal is also interested in passive income, investing for passive income. Investors often seek to create a source of passive income throughout investing. Like dividends from stocks or interest from bonds, the income can provide financial security or supplement their source of income. Right? It is essential to remember that the motivations for investing can vary widely, and the best investment strategy depends on an individual's financial goals, risk tolerance, and time horizon. Now, the central concept of investing. I would have mentioned earlier investment goals. Before anyone should invest, before you invest, begin investing, it is imperative that you determine your financial goals. What are you looking to grow? What are you looking to achieve? Are you looking to grow your wealth, save for retirement, or achieve short-term objectives such as buying a home or funding your child's education, as I mentioned earlier? Ultimately, your goal would influence your investment strategy. Therefore, your investment goals must be smart. We'll move on to the concept of risk and return. All investments involves a trade-off between risk and returns. Generally, the higher risk investments have the greater potential for higher returns, but also greater potential for loss. The converse is also true. Low-risk investments typically offer lower returns but greater stability. Risk tolerance. Assessing your risk tolerance. Some investors carry more risk than others. Stocks, for example, tend to have a higher potential for return but also higher volatility. Bonds or savings accounts are generally low risk. Your risk tolerance will help you determine an appropriate mix of investments. Diversification. How should I allocate my financial resources towards achieving my investment goals given my risk appetite? Diversifying your investment means spreading your money across a variety of asset classes, such as stocks, bonds, real estate, etc., to reduce your risk. A well-diversified portfolio can help mitigate the impact of poor-performing investments and enhance your overall stability of your portfolio. Asset allocation, the process of dividing investments among different asset classes, plays a critical role in diversification. Time horizon. How long should I invest to achieve my investment goals? Consider how long you plan to invest. Longer investment horizon allows for riskier investments, as you have time to ride market fluctuations. Short-term horizons, however, requires a more conservative investment strategy. We move on to the type of investment asset classes. There are numerous types of investments available to individuals and organizations, each with its own set of risk and return characteristics. Here are some of the most common types of investments. Stocks, for example. Stocks represents ownership in a company. When you buy shares of a company's stocks, you own a portion of that company. Stockholders may benefit from capital appreciation or dividends, but they also face the risk of losing their investments if the company performs poorly. So a risk involved in purchasing stock would be company risk. Individual stocks can be affected by company-specific factors such as financial performance, management decisions, and competitive pressures. Bonds. Bonds are debt securities issued by government, municipalities, or corporations. When you buy a bond, you are essentially lending your money to to the issuer in exchange for periodic interest payments and the returns of the bond face value at maturity. Risks involved in investing in bonds. You have interest rate risk. Bond prices may fall when interest rates rise, and vice versa. You also have credit risk. There's a risk that the issuer may default on its interest payments, or may default on the principal repayment. You also have the mutual funds. Mutual funds represent a pool of money from multiple investors to invest in a diversified portfolio of stocks, bonds, and other securities. They are managed by professional fund managers and offer diversification, but it comes at a fee. Right? The risks associated with investing in mutual funds. You have market and asset-specific risks. Mutual fund investing varies across assets, so their value is subject to market and asset-specific risks. Management risk. The performance of mutual funds depends on the skills and decisions of the fund manager. Real estate investing. Real estate investing involves buying physical property, such as residential or commercial real estate, either directly or through a real estate investing trust. Real estate can generate rental income or appreciate in its value. The risks associated with investing in real estate are centered around market risks, liquidity risks, and property-specific risks. Now, market risk, real estate values can fluctuate based on location, national economic conditions, and liquidity on a whole. Real estate are relatively illiquid and makes it challenging for an individual to quickly convert their real estate to cash. Property-specific risks. Property values can fluctuate by factors such as location, maintenance costs, and property management costs. Commodities. Commodities include physical goods such as gold, oil, agricultural products. Investors can buy or sell commodities directly, invest in commodities futures. Risks associated with investing in commodities span price volatility and, in some cases, storage costs. The price of commodities like oil and gold can be highly volatile due to the influence of supply and demand dynamics. Storage. Physical commodities may incur costs for storage or maintenance. If we look, for example, at certificates of deposits and savings, that's another form of investing. CDs, as they're passionately called, certificate of deposits, are deposits offered by banks with fixed interest rates and maturity dates. They are low-risk investment, but typically offer low returns compared to other investment options. Savings, similar, but these are money that are placed in savings account with a bank or credit union on interest through the returns. Though returns are generally lower than other investment opportunity, as I mentioned before. The risks associated with investing in CDs and savings accounts are low returns. These investments typically offer low returns compared to other investments, and inflation may erode the real value of your savings account. If we could move on to the pitfalls to avoid when investing. So one of the pitfalls to avoid when investing is to avoid not doing due diligence, as is stated there, lack of research. One of the biggest mistakes investors make is not conducting enough research. Understanding the company and the investment instruments that you're putting your money in is essential to align your investment goals with your stated expected or targeted returns. Emotional decision making. Emotional decisions, especially panics and fear, can lead to impulsive actions. Successful investing requires a cool head and a long-term perspective. Don't let short-term market fluctuation dictate your investment activities. Lack of diversification. Diversifying your investment portfolios across different investment asset classes such as stocks, bonds, real estate, etc., and sectors and also geographic location can allow you to spread your risk. Putting all your money into one investment can be extremely risky if the investment is poorly. Chasing performance. Just because a particular investment performed well in the past doesn't mean it would continue to do so in the future. Investments go through cycles, and past performance is not a reliable indicator of future results. Ignoring the impact of taxes. Taxes can significantly affect the investment returns. Be aware of the tax implication of your investments and consider tax-efficient investing strategies. Remember, render unto Caesar what is Caesar's. Not reviewing or rebalancing your investment portfolio. Your investment strategy should be reviewed periodically and adjusted as needed based on your changing investment goals, market conditions. Rebalancing your investment portfolio to ensure that it stays in line with your risk tolerance and financial objective is critical. Not having a long-term plan and not having a defined investment goal. Investing without a clear plan is like driving without a roadmap. Define your financial goals, risk tolerance, and investment horizon. Having a clear plan will guide you in your investment decisions. Overconfidence. Confidence is good, but overconfidence can lead to excessive trading and assuming higher levels of risk than are prudent. Always be aware of this risk. Always be aware of the risk involved and be humble about your ability to predict the future. In summary, investing is a powerful tool to achieve financial goals, but it requires knowledge and thoughtful decision making. By understanding the basic principles of investing, individuals can make informed choices, manage risks, and work towards financial security and prosperity. Continuous learning and adapting to changing market conditions are key to successful investing over the long run. Remember that investing involves inherent risks, and it's advisable to consult with a financial advisor or conduct thorough research before making investment decisions. The way to get started in investing is to quit talking and begin investing. Thank you.
Thank you, Mr. Antoine, for your presentation and for giving us some insight. As he was speaking and he went to the slides, I was trying to figure out where I was and who I was. I think I'm stuck between David and Grace, wanting to save for my retirement because I'm getting up there in age, and trying to leave something for the future generation. So I'm trying to figure out what's the best strategy for me to do, because I really want to be on a beach somewhere when I'm retiring. I don't want to leave everything for Alexa, so I'm going to have to figure my plan out, how I'm going to get that done. Okay, so up next we have Mr. Alan Sheppard. And as I said before, he will be joining us virtually. And I will read a short bio for Alan. Alan has asked me prior to ask everyone present to have their smartphones ready, because he's going to do something interactive with your phones during his presentation, and your QRC barcode scanner, if you have that. So you can have that ready. Okay. So, Mr. Alan Sheppard, after graduating from the University of Western Ontario with a Bachelor of Arts in Economics with special focus on international financing and banking, Alan began his career in the mortgage and pension fund industry in Trinidad. 3 years later, Alan joined Investors Planning Associations Limited, a London-based organization gaining international experience in private wealth management with specific focus on high net worth individuals. During this time, Alan also completed MBA modules in economics, accounting, marketing, and negotiation at the Edinburgh Business School. Since returning to Trinidad in 2004, he has held various senior positions overseeing the portfolio management of both individual and institutional investment portfolios. At Sheppard Securities, he is responsible for the growth of third-party assets and the direction and development of the wealth management team. Alan keeps the wealth management team focused on growing the firm's assets under management. On the lighter side, Alan is a family man and a fisherman, an avid sportsman, especially if the sports includes a beer or two. Let's welcome Alan this afternoon.
Hi, good afternoon, everyone. I hope everyone is seeing me okay. All right, so I wish I got the attendee list so I could thank everybody in attendance. I just want to thank everyone for having me on today. It's always good to know that, part of the Caribbean region, reaches out to other Caribbean countries, to help each other out in any way we can. So thank you again. So I'm going to start the presentation. Mr. Antoine, I hope he doesn't mind mixing up Antoine and Antoine. He touched on a lot of the things I'm going to touch on, which is good because it means we both think in the same way. So I'm just going to share my screen so I could start my presentation. Can everyone see that? I hope so. All right, so again, thank you for having me. So I'll just run into it. I just want to touch very, very quickly on Sheppard because I know most in attendance won't know who Sheppard Group is from Trinidad. So Sheppard Group, Sheppard Securities is the holding company. We have a stock brokerage firm registered with the SEC and the stock exchange in Trinidad. We also have an investment advisory firm, an execution firm in St. Lucia. So we have Sheppard Investment Services St. Lucia Limited. We also own a insurance brokerage because we also believe that clients' assets need to be protected. So after you've invested and bought your house, obviously you need to protect it in case any adverse events. And then we recently opened up a Sheppard FinTech company. As we all know, FinTech is the way forward, especially in our industry. So we have started a FinTech company. We have 6 people working in the FinTech company right now. So just a little more Sheppard. We start January will be 15 years in existence. We currently manage just about $1 billion worth of third-party assets, so client assets. We've grown quite significantly over that 15-year period. We have a staff complement of 60 staff now. We do trading and execution on most exchanges all over the world. So we have 14 different currencies in our book. We trade on 30 different exchanges. So the London Stock Exchange, the Canadian Stock Exchange, Australian, you name it, we trade on. We maintain relationships with all the banks and brokerages in Trinidad. We also are very lucky to get access to the Bank of New York and Pershing LLC's platform for all our international assets. So All foreign, as in non-TT dollar assets, are held in the Bank of New York in client name. Most of our assets are outside of Trinidad and Tobago dollar. Anybody who follows Trinidad knows that foreign currency is a big thing in Trinidad now. So we try to assist clients, getting currency and investing outside of Trinidad. And again, between the executive, we have quite a lot of experience. So as Jasmine mentioned, if you could, I hope you could scan this QR code. What's going to come up is 3 words. Any 3 words that anyone in your room can think of what the first thought that comes in your head when you hear investment. So that's all I want to do. It could be anything. There's no right or wrong answer. The real goal of this is just to show everybody in the room how many different answers we get. Even when we talk to financial professionals, how many answers we get when that simple question is asked: what is the first thing that comes to mind when you think about investments? Right. Very good. So as people enter words, it's going to come up, and if a lot of people put money, money will get bigger, and that sort of thing. So I'll just give everybody like a minute or two to. Sorry, is everybody saw the QR code? Yeah. I can't hear anybody, so I hope. All right. All right. So obviously, wealth and money are the most popular answers in the room, followed by risk, which is very good as well, and then return. So again, this is just a little interactive that we like to do with presentations, because you'll be surprised how many different words we get. So thank you very much for doing that. I'll go back to the presentation. All right, so again, Mr. Antoine spoke on all this, so I'm not going to go into detail. What is an investment? It really is the expectation of getting a return over time, right? So it could be many different things, but the expectation is that if you invest in something, that you have a reasonable expectation to make money or to earn a return on that investment. It is completely different to depreciating assets. So some people, and I get it for many different reasons, think that buying a boat, or but not a boat for fishing, but just for pleasure, or for you and your family to go on. That's pleasure. That's not an investment, and that actually costs a lot of money. Is purchasing land to build a property and rent it out an investment? Absolutely, it is. Buying a car for your daughter when she's 17 and gets a license, is that an investment? Probably is not. Buying $20,000 worth of stocks or equities or bonds from an investment company, absolutely, that's an investment. All right, so I just wanted to differentiate between what is an investment and what is a depreciating asset, because in a depreciating asset, there's really no real expectation of earning money or getting a return on that investment. Again, Mr. Antoine touched on already, so I won't spend a lot of time on it. Equity or stocks is direct ownership in a company. So if you own your own company, you own 100% of that stock. A lot of companies like Apple and Coca-Cola and Exxon and a lot of companies issue their shares on the stock exchanges, and you are allowed to buy ownership into these companies, and then you participate in the dividends or the growth of the company, or the fall of the company if it doesn't do very well. Equity is usually the kind of the most riskiest investment, as he said. Fixed income, otherwise known as bonds, involves securities. So companies or governments come to the market, come to investors to borrow money, and they pay them a return. They pay them an interest rate in exchange for that money. It usually is a fixed period of time. So the government might borrow money for a 10-year period and give you 6% a year for 10 years. And then at the 10-year maturity, they give you back your money, or they offer to roll the investment into another 10-year bond, or whatever is the case. So bonds are literally, it's the debt instrument that either companies or governments borrow from the market in return for an interest rate that's paid to the investor. Cash, it is literally what cash is, or cash equivalent. So money market funds are considered as cash equivalents as well, because they can easily be turned into cash if you needed it. So we can advise clients that you always need to keep a bit of cash for rainy days, that you could easily touch if something adverse happens, like a medical emergency or something. You always have to have a cash portion of your entire investment portfolio. Real estate, again, he touched on this. So, land, buildings, commercial, residential real estate are a little more difficult to turn into liquid cash. There's a 90-day buy period and so forth, and it takes a little while to sell and so forth. So it is an asset for sure, and it is an investment, but it is more of a long-term investment, because it takes a little while to convert this into liquid cash. Mutual funds, again, it's a pool of assets. Thousands of clients put their money together, which gives you better buying power, and a professional investor manages these mutual funds. These were very popular in the early 80s, 90s, into 2000s. What has sort of replaced this is what is called an exchange traded fund. So it's just a much cheaper version of a mutual fund, because mutual fund managers usually charge like a 2% a year management fee. The exchange traded funds, you get loads of diversification, but for a much less fee. All right, this is something we didn't touch on, but I think it's equally important, and I really wish that schools across the entire region would teach this. Budgeting is a very, very important part of life in general. So everybody knows you spend more than you earn, you're going to run out of money. And that is from a household to a government to a company to every single body. So, you need to set long-term financial goals. You need to have proper spending habits and proper budgets, and that's the only way you're going to create financial stability. So there's a little budgeting tips. There's no way everybody's going to be able to follow this. We all know that some months are very difficult, some years are very difficult, and you won't be able to put aside money, but you need to at least have a plan, where 50% of your money goes for recurrent expenditure, so for your groceries and for your rent and so forth. 30% of money. So we're not saying that you can't have a good time and go to the movies and travel and so forth. So you can use 30% of your money, but you should always try to put aside some of your income to savings and investments. In the side slides to follow, I'll show you how important that is, that you start, as early as you possibly can. Obviously, when you come out of university and you just started working, it's very difficult to start savings, and we know that. But there are little things that you can do to put aside money before your entertainment and travel and so forth gets prioritized. This is a very, very beautiful slide on compounded. Simple interest and compounded interest are two completely different things. Simple interest is you have $10,000 at 5% a year, it pays you $500 a year. Very, very, very simple. You take that money out, the 10,000 stays in. Next year, you get $500. Third year, you take that out, same $10,000, you get $500. Your return over a 10-year period will be $5,000 because you started with 10. At the end, you'll have 15. Compounded interest is you don't take the interest out. So 10,000, you make 500 the first year. That goes back into your capital, and you get interest on your interest again. The cumulative difference at the end of the same 10-year period, starting with the same $10,000, you end up with $16,288. It sounds like a small difference, but that's almost 10% more in return you get over that period just by compounding your interest. So I thought this is a very popular slide. I mean, a very powerful slide, because if you can reinvest your interest or your dividends that you receive on your investments, compounded plays a very important role. I mean, it is a fantastic thing if you are able to reinvest your interest or dividends into more shares or more bonds. Equally as an important slide, and Mr. Antoine touched on this again, understanding your risk tolerance is probably one of the most important things that any investor will ever do. Most people, and this everybody is the same, they want high returns, but you don't want to take a lot of risk. Unfortunately, that does not exist in our world. High returns are accompanied by higher risk. So if you are an investor that your portfolio looks like it's down 10 or 15% in 1 year, and you're getting anxiety, and you're uneasy, and you're calling your investment advisor, and you're panicking, then the aggressive approach is not for you. Most people, especially the 35 to 45-year-olds, kind of go into the balanced approach. They want to get a better return than the low risk assets, but you don't want to take too much risk where you have a risk of losing your entire investment. And then obviously, as you get older and more mature, most investors convert into conservative investors, because you're getting close to retirement, and you literally cannot take the risk of losing your capital when you're close to retirement, because you don't have the time to start over. Obviously, once you understand your risk tolerance, then these portfolios become important. So the more you diversify your portfolio in multiple different assets and asset classes and currencies and geographies and everything, is the less risk you're going to take. Obviously, I mean, the famous saying, don't put all your eggs in one basket. A lot of people fall for this, that, they love Amazon and they love Tesla stock, and they put a huge portion of their portfolio in this. All well and good when things are going great. But when things are not doing well, that is a huge risk that some investors take by putting too much of their money into one asset. So diversification is very, very important. And again, as Mr. Antoine ended, if you don't understand diversification, you should really talk to a financial professional, either in your bank or brokerage or something. So yeah, multiple different asset classes, different sectors. So you have energy, healthcare, consumer. Again, if you don't understand, you should really speak to an advisor to help you understand. Global investing helps diversification huge as well. This is just a visual of diversification. So international equity, so buying, stocks on the London Exchange or the Canadian Exchange, 5% in cash. So again, as I mentioned earlier, cash is always a very important portion of your overall portfolio, not only in case you need it for adverse events, but it also allows you to take advantage of, if markets, do pull back and underperform, you have some cash to deploy when assets are at cheaper prices. US equities, so, the S&P 500 and the Russell 2000 and Apple and those kind of assets. I would say we live in Trinidad here, so the local stock market is a portion of most of our clients' portfolios. Corporate bonds, government bonds, as I said, governments are usually a very safe place, once they're decently rated and so forth. And then you have sectors. So apart from US equities, then you also have technology. So you have Amazon and Apple and so forth, utilities, so the energy, the water and electricity producers, consumer staples, so the Johnson & Johnsons of the world and the Pfizers and so forth. So this is just showing you both not only asset, but also sector diversification in your portfolio as well is very, very important. This is probably my favorite slide, and the next slide will show it even more. He was very right. The sooner you start investing, you need to get off the couch and you need to start doing. starting at 25 years old, $3,000 per year for 10 years, and then you stop. You don't add a single dollar to your investment account after that. At 7%, you've made $30,000 in investments. So $3,000 a year by 10 years, $30,000. At 7% a year, at 65, you have $338,000. If you start just 10 years later, so you start at 35, same $3,000 a year, but you put this for 30 years. So you keep on contributing for 30 years. So you've put in 90, same 7%, you end up with less money. That is the power of starting as early as you possibly can. And that is also a function of compounding for a long, long period of time. Right? So, I mean, anybody who say they can't afford it, I mean, anything you can start investing or saving with, you should start at the earliest age that you possibly can, because it makes a huge difference in your retirement fund or your education fund or to buy homes or whatever it is. So this is something that's on our website. So I'm just going to run through it really, really quickly, and you can at your own time you can play with it. Just open it up. So this is a calculator that we use. So I am just going to put my name. I wouldn't put my real date of birth to show my age, but I'll put 01/01/1983. I want to retire by I'm 65 years old. Oops. I'm still young, so I'm a balanced investor. I am contributing monthly to my savings. I'm putting aside $2,000 TT dollars a month. Oh, sorry, I'm starting with 2,000. I put in 2,000 TT a month into my pension. Right, so it gives you an idea, and this is based on historical returns of our portfolio. So this is not just pie in the sky, numbers. It gives you, so when I'm 48, again, this is a pension fund, so you'll see a tax savings figure there, and he's very right. In Trinidad, we're allowed to max out up to $60,000 a year into a pension fund. So over that period, I've contributed $580,000. My pension value is $1.1 million. And it shows you if you were to change your strategy from balanced to conservative or to aggressive, what your ending balance would be. So, I mean, this is just a really cool tool that anybody could go to the website and play with. Like literally, you could put in whatever, change up your monthly payments amounts and that kind of thing, and it gives you a very good idea of where you will end up into retirement. Yeah, so please feel free to go on the website. We encourage everybody to go. All right, so how do I start? Right, so this is the most important thing, because everybody says, well, I don't know what to do. How do I get started? Number one, understand your investment goals. What are you saving for? Is it retirement? Is it for your daughter to go to university in 8 years' time? Is it, to buy your first home? Once you understand your goals, then you understand your investment risks. Then it is very easy to start. You really only have to contact anybody in the financial sector. I mean, somebody at your bank, somebody at the brokerage company, somebody at Sheppard. Anybody will be able to tell you how to start. I mean, you could even go to interactive brokers. I mean, there are many, many avenues that you know how to start. But number one is understanding yourself, understanding your investment goals and your risk tolerance. So then step two is, how much can I save? Like, how much can I put aside? And that only comes from budgeting. So it literally is, and it is not popular and it's painstaking, but it literally is sitting down and building a profit and loss statement on your personal, so your salary minus your expenses. What do you have to invest? And that's important. That's a very important thing that very few people do, that I wish they would teach in schools, to show people and young kids how to actually budget. And then once you understand your risks, you understand how much you have to invest, It literally is just to consult with somebody and to set up an account somewhere. I know I'm making it sound very simple, but it really is. Once you put your mind to it, it really is very simple. So key takeaways. It's important to know the difference between an investment and a depreciating asset, because they're two drastically different things. Budgeting, I will harp on this again, is a very important skill that everybody should know and everybody should do, not only in your company if you're an entrepreneur, but at home, in governments, in everywhere. Budgeting is extremely important. The earlier you start investing is the better. I cannot stress that enough. Your money will have a lot more time to grow, and compounding works brilliantly the longer you have. And then diversifying your portfolio into different asset classes. So don't put all your investments into one stock or one asset or one sector or anything like that. The more you diversify your money is the best, and it also reduces your risk of losses. Right, I know I spoke for a while there, so anybody has any questions, please feel free to pass them on. And I hope I didn't bore you. And thank you again for having me.
Thank you, Mr. Sheppard. Thank you for your presentation as well. There were quite a few takeaways from me from Mr. Sheppard's presentation. You know, budgeting is something that we always hear about, we all know, but it's very difficult to practice. It's very, very difficult to practice, and I can say so from personal experiences. I've tried to budget, then I do a rolling one, then I do a disappearing one. And so, but over the years, you know, as you become older and you realize you're reaching to the age of retirement, you have to start changing your mindset. And so when I was 25, I wasn't thinking of that. So I've passed that stage. So 25 is out of the window, and so is 35. But I have started. So I hope we have taken something from Mr. Sheppard's presentation, and we will try to, you know, put something into practice. As he stated, if anyone had any questions for him, we want to take that now. We are cognizant of the fact that he's online, and, you know, he did say that he was on a time. He was on a time. So I'm not quite sure. No questions for Mr. Sheppard? Okay, so Miss Moran? Mr. Sheppard, I have a question here for you.
Sure.
Romilly? Yes.
Good evening. In both presentations this evening, there was talk about monitoring as well as due diligence. What I would like you to share with me is, what are the things do we look for? In that you shared we can check with a broker, an advisor, or even shepherds. What are the things should we look for to determine whether or not we use these persons, since that we would be green in this investment area?
Very good question. So first of all, you have to make sure that they are registered and regulated by their respective entities. So in most jurisdictions, that's the Securities and Exchange Commission. But I mean, I think in England, they call it the FSA, the Financial Services Authority. So first things first, all of these regulators have websites that have listed entities that are regulated and approved to give advice. Most of them also have the company's financial statements and all the directors. So there's a lot of information you can get from the regulatory sites. And then obviously when you speak to them, I mean, you have to make sure that, you know, they are reputable. So there are numerous ways of finding out, you know, reputation of clients and how long they've been around, how much assets under management. So, you know, if they've grown, you know, significantly. You know, a lot of people are trusting them. How many clients do they have? All this information can be found quite easily, most on companies' websites as well, but by asking around as well. So don't doubt word of mouth, especially in Caribbean islands. I mean, it is very easy to find out things about people in the Caribbean islands. So a multitude of things, but I would think one of the most important things is to make sure that they are approved and above board and regulated by the entities in their jurisdictions, and that's very easy to find out.
Okay, thank you for that. The other question I want to ask you, what would you advise in terms of monitoring those investments? How do one go about monitoring those investments?
All right. So it depends on what asset class you're in. In a mutual fund type investment, the asset manager does do either monthly or quarterly rebalancing. So they will look at the mandate of the portfolio, or what is termed as the investment policy statement, to make sure that they're not they don't have too much money in stocks and not enough in bonds and so forth. So in a mutual fund, the asset manager will do that automatically. We also do on a quarterly basis, but we are sort of a little more niche that we speak to the client directly, either on a monthly or on a quarterly basis, to make sure that the goals haven't changed, that the return criteria is the same, the time horizon hasn't changed. And most institutional clients, so credit unions and governments, most of them have investment policy statements that actually state what you can and cannot invest in. So that guides an investment manager as to what they can buy or cannot. On an individual basis, it really is just understanding the individual. And that's why it's important to understand your own risk, so you don't go into a fund or into investment that is way above your risk tolerance, because then you can get into trouble and incur some losses. So it's really, if you don't understand, I mean, research is one of the big things. I mean, to try and read up on the asset allocation of a fund before you invest in. But talking to people, I find, is usually the best thing. Talk to people that you know and you trust in your bank or in your your social or whatever, because you'll be surprised and you'll get some information that may be useful.
Agreed. But then when you look at our small community, and then we don't have, well, limited. I'm not sure if there's anyone around us except probably at the Bank of Montserrat. I'm not sure many of us utilize brokers and all of that, so therefore we would have gain information on their reputation and what they're doing. And third-party risk is a big risk.
Yeah, agreed. And that's why when I started off, I mean, we were very lucky to get into the Bank of New York Mellon Pershing, because they're the largest custody house in the world. And we open accounts in client names. So it's not in Sheppard's name at all. The account is in your name at the Bank of New York Mellon, which is a very important thing. I mean, that takes away the third-party risk with us, because the account has nothing to do with it. We are really just the advisors on the account. But I mean, I think if you reached out to Jasmine or whoever, and anybody that needed to set up a small session, again, I will have no issue doing that. I mean, I love education. We go to secondary schools, and we talk to 15 and 16-year-olds all the time, because this is not taught in schools, and it is an important integral part of life, but you don't realize that until you're 35 or 40 years old, unfortunately. So it really is about education, and you don't ever have to be a very sophisticated investor. Once you learn the basics and understand, what is a bond and what is a stock and the associated risks with them, then you usually are able to navigate quite easily. But it does take a lot of reading, and I mean, you'll have to do your own research and follow the Bloombergs and the usual Yahoo Finance sites and so forth. But I mean, education is key, and again, I would have no problem setting up small sessions if anybody. But I'm sure the Bank of Montserrat will be able to do that for you as well. But I'm more than willing to set that up if anybody needs, that wants follow-up sessions or whatever.
Agreed, but where you have all this scandals going, I mean, in the financial sector. I mean, that is of great concern to one. And so we place our trust in institutions. And that's why I asked you the question about monitoring, because we trust them, we are not necessarily the expert, and then, you know, later on we are disappointed.
Yeah.
You know?
I hear you, and so it's a valid point. At the end of the day, you still have to show interest in your investment because it is your money, it is your investment. So I would never tell anybody to give an investment manager money and then, you know, close your eyes and go check on it for 10 years and then come back. More often than not, clients that take interest in their own portfolios usually outperform as well because the dialogue is always there. I mean, I could speak for us. We have live online access, so you could literally log on every single day and see live pricing. I mean, most people don't because that'll drive you a little crazy. But, you know, the information is there, so you can track it all the time. But yeah, I mean, it's a risk, and history has proven, again, somebody put Enron up there, that happened. You can't shy away that, you know, a lot of people lost their retirement savings in a company that was huge, right? So yeah, there is that risk as well. So, I mean, yeah, again, that's diversification too, right? So, I mean, you don't necessarily have to put all your assets in one place. So the brokerage houses, though, they're slightly different because they really just custody assets. So you could have multiple different assets in a broker, but there's no third-party risk with the broker because you own Apple, you own, you know, Tesla, you own multiple different assets. So for all, you know, if you diversify properly, for all your investments to go down significantly once you're properly diversified is unlikely over a long-term period. But yes, there is risk. I will never shy away from that.
Thank you.
You're welcome.
Thank you, Ms. Marine. Any other questions? No? Okay. Alan, I want to say thank you very much. I know you did say that you had another engagement, so if we don't see you again for the night, thank you very much, and thank you for
no problem. Thank you very much for having me, and it was great. Thank you very much.
Miss Eswick, being her usual self, has said she would like to have some questions to see if everyone was being attentive, and she has some giveaways. Pardon? Oh, I'm sorry, Mr. Antoine. They're asking. Anyone has any questions for Mr. Antoine? No. Okay. All right. Yeah, so back to what I was saying. Miss Eswick, she's saying that she has some giveaways. She wants to know if we were all being attentive this evening. So we have two questions that we want to ask. The prizes are not here this evening, but she will, whoever the winners are, you will get your package at a later date. Pardon? No, it's not high risk. This is sure. This is sure. Miss Eswick will deliver on her promise. You will get your gift. So, okay. The first question is, we want to find out, if you were listening, in Mr. Antoine's presentation, he gave us some pitfalls to avoid when investing, and I was wondering if anyone can give me 3 of them. That's too much? 2? 3? No one took any notes? You want to borrow mine? Pardon, Miss Moran?
Emotional decision making to avoid, chasing performance.
Yes.
And ignoring the impact of tax.
You have any more?
Sure.
You were
Not
doing
reviewing
good.
and rebalancing the matter.
Okay, so Ms. Moran, we have a winner, Ms. Westwick. Okay, and the last one, so Mr. Sheppard's presentation, and this should be an easy one. He outlined 5 classes, asset classes, and I was wondering, 3? Anyone can give me 3? Gentleman in the back. I want 3. He gave us 5. Give me 3. Okay. Thank you, Mr. Amar. Okay. Okay. So just to bring this evening to a close, I would just like to say thank you to everyone for accepting the invitation this afternoon. I want to express my gratitude to the ECCB Agency Office, Ms. Eswick, and her team, and also our FIM partners for their continued efforts in educating our community. Just to say thank you. I have a list here of our partners, and we wanted to mention them by name specifically because over the past few months, they've spent quite a lot of time planning the FIM month. So in collaboration with the ECCB Agency Office, we have the Ministry of Finance and Economic Management, we have the Montserrat Social Security Fund, the Bank of Montserrat, Financial Services Commission, the Ministry of Education, RX Jim and Ryan Darrow, Regal Dental and Dr. Coretta Fergus, Flo Montserrat, Digicel Montserrat, the Braids Primary School, the Office of the Premier, the Statistics Department, the Trade Division of the Office of the Premier, the Montserrat Red Cross, the Montserrat Nurses Association, the Government Information Unit, ZJB Radio, the Montserrat Secondary School and the Montserrat Community College, St. Patrick's Cooperative Credit Union, and the Montserrat Building Society. We also want to say a special thank you to the Philomagic Media and Sound for this afternoon. Thank you very much. Ms. Eswick has asked that you join her and the other partners downstairs for some takeaway refreshments. Thanks again for coming. Thank you.